Good afternoon and welcome to this week's macroeconomics analysis session for October the 30th, 2015. You're with DMAC and sitting alongside me is Jeff Saffer, head of the Elite Investors Club. Welcome to you, Jeff.
Thank you, David. Hello, everyone.
And first and foremost, as usual, our disclaimer: the content of today's presentation or any other Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation or particular needs. Before making an investing decision based on the general advice presented in any of our presentations, please consider whether that advice is appropriate in light of your financial circumstances. You can pause the recording now and read the rest of that at your leisure. All right, let's go through and have a bit of a look at the week in review, Jeff. Not a huge amount of data this week. I'll let you go through and pick out the really important aspects, and perhaps we'll just discuss a little bit of the impact on our local market in particular.
Yeah, thanks, Dave. Again, as you sort of suggested, no huge game changes that are going to really drive global markets, but a couple of little regional themes at play. So we'll just kick off in Australia. The big news this week was really CPI, lower than expected, so inflation. The RBA said for a while that inflation looks under control for the next 1 to 2 years. This data was, fairly weak, and low inflation around the world is really prevalent, despite low interest rates, which should encourage spending, which should encourage economic growth and inflation. It's just not there. Pretty much no country can generate inflation in their region. So really, the significance of that is we've got an RBA rate decision next week. Up until the CPI data, that was maybe a 1 in 3 chance of being another rate cut. After the CPI data, it's now about 50-50. So to use a bad pun, it's an even money bet on Cup Day. That we'll see a rate cut. I look probably leaning towards them being on hold. I still think the RBA really wants to keep rates on hold. I think they don't want to cut. Having said that, obviously the CPI gives them a bit of ammunition. Look, we can cut rates and it's not going to send inflation out of control. And also they've said recently that property prices are a little bit more under control, so they don't have to worry that if they cut rates, property market's going to go berserk. So, look, probably 50-50. My gut says on hold, but certainly wouldn't be surprised if they cut.
So that's a bit of a theme right around the globe, isn't it? That interest rates are heading towards zero just about in most of the developed countries. Just a question on that, if I can.
Yes.
You talked about inflation not being a major issue in any of the developed countries at this point in time, and yet a lot of the gold mining stocks in the Australian market have moved of late. What's the theory behind that?
I guess a couple of things. So, number one, we've had the Aussie dollar weaker, which is certainly helping gold miners. On top of that, you've got you're alluding to this because gold is seen as a hedge against inflation, right? So if you put $1,000 in the bank, and inflation is at 5%, at the end of the next year, your forget interest for the moment. At the end of the year, your $1,000 is actually worth less because of inflation. The thinking with gold is, I buy an ounce of gold, and inflation goes up 20%. Doesn't really matter. I've still got an ounce of gold, and that's why it's seen like that. I think we're not really seeing any inflation at the moment. Some countries it's basically at zero. And some countries it's even negative. But in the US, I think, whilst we're not really seeing inflation kick off there, I think it is inevitable that it's going to happen. So it's probably factoring in a little bit more longer term. There's no real huge signs right now, but with the current policies that we've got around the world, it has to lead to inflation. Eventually.
Okay. So what are some of the main indicators that might be starting to creep up? I mean, obviously we talk about CPI as being an indication, but are there any other sets of data that you monitor to sort of as a barometer for underlying inflation creeping up?
Look, I mean, the inflation numbers are really the best place to
Yep.
look in order to get a gauge on that. But what you can do is it's not quite a perfect relationship, but you can look at things like retail sales, business investment, and that's obviously if people are spending money, that stimulates the economy. It drives higher prices. If business investment increases, then they are in competition for, if businesses are investing more, they're expecting to grow, they hire more staff. As you hire more staff, you have to pay more to get the right people.
Yep.
If no one, and at the moment we have very little wage growth
Yep.
because unemployment is steady,
Yep.
but there isn't this huge competition for workers that we saw a few years ago.
Yep.
And you can go out there and say, I want to hire someone, and there's someone available for the job, and you don't have to pay them a big bonus to sign on and a big salary. So
Yep.
things like looking at wages, looking at retail sales, and looking at business investment. I think those three give a bit of background to economic activity and demand and levels of spending,
Yep.
because those are the things that ultimately are going to drive prices
And
higher.
they're going to feed into inflation. Okay.
Yep.
Thanks for that, Jeff.
I'll look over in Europe. I mean, I won't go through every piece of data, but over in Europe, certainly British GDP was weaker, and German business confidence, it continues the trend of disappointing data in Europe that we've probably seen for, going on 4 or 5 months now. And in the US as well, pretty much every piece of economic data out this week was below expectations. And that's painting a picture that we've probably seen. Look, we've seen a somewhat of a slowing in the US for basically 12 months. Nothing major, but certainly the big growth of the previous few years had sort of petered out. And then we've seen much choppier data in the US for sort of 2, 3, 4 months maybe. And that culminated in, as expected, the Fed came out and said, look, we're keeping rates on hold. We're not ready to hike yet. They did say if they continue to see signs of improvement in the US economy and no further weakening in overseas economic conditions, then they will raise rates soon. The market actually saw that was the statement this week. The market went, oh, hang on, we could very well see some improvement in the US, and if we don't see anything bad overseas, then we could get a rate rise soon. December, the Fed has said, they've got their eye on 2015, so the market's starting to get a bit of a feel that they could raise rates in December. Back and forth a bit, but I think they might be reading a little bit too much into it. I think the Fed just leaving their options open.
Yep.
They've left it vague enough that they can justify either way.
Yep.
So I think we still don't see a rate hike in December.
Yep. Okay.
Speaking of sort of stimulus or pulling away stimulus in Japan, been talking about for a while that I think they're on the verge of announcing more stimulus. We could get something late this afternoon. And in New Zealand, more rate talk. They left rates on hold, but they hinted that, again, in order to get inflation kick-started, at some stage they're probably going to have to cut rates again.
Yep. Okay, but no change for the time being, and it'll be interesting to see what happens next Tuesday, whether Australia happens to do anything with its rates and what the talk is around that. Right, rather than having a look at the week ahead at this stage, let's go through and have a look at the actual markets themselves. The XJO there, the ASX 200. You'll see as the time has gone by, the annotations not changing a hell of a lot really, other than just drawing in just this little bit of support and resistance, a bit of a zone here at the moment. We've talked about the need previously to close convincingly above this level, which we did last week, and since then the market's really just drifted back down towards what was a ceiling is now looking like it's trying to act as a floor. The market being down a little bit today. It'll be interesting to see how we finish up, whether or not we're able to close above that sort of 5,300 level. It's got a fair bit of work to do if it's going to do that today. Certainly from a price action point of view, really needs to start finding some support there. We've certainly got higher troughs on the way through, which is a promising sign. And those of you in Melbourne, with the Herald Sun this week, I wrote actually an article about the importance of having rising troughs, particularly when you're looking at individual stocks. So the index itself is starting to show that sort of price action, which is positive. It would be nice to see another higher trough put in, and then some closes back up around, getting close towards the 53.50 level. That would be a promising sign. Our market risk is improving gradually. It's taking a little while. We're just about in, we're still in very high risk. We're getting closer to high risk at this point in time, but certainly, we're in a difficult part of the world. If it's not news from the US, it's news from the Asian markets. So at this point in time, we've still got a long way to go back to the lofty heights at the beginning of the year, where we were up around about 6,000. In the US, by comparison, you can see that whilst the beginning of the year we drifted sideways, we fell out in big volatile moves. Since then, we've nearly regained all. In fact, we have regained all of that
collapse.
The collapse to the downward side. We've gone back up and really looking strong. I mean, last night's candle, certainly nothing conclusive there at all. A bit of a doji there, but the night before being very, very strong. Really good price action, and this is what I'd like to see on the Australian market, coming back down, retesting, and then a nice strong follow through. So certainly that price action, if we can get that in the Australian market, then that will lift the portfolios of a lot of retail investors out there. Jeff, you got a question?
Yeah, I was just going to point out that the US has finally reclaimed that dominant candle and pierced a soldier and all sorts of things. So you've been talking about that for quite a while.
Oh, I'm glad you've been listening, Jeff.
Oh, sometimes.
Yeah, certainly. Look, the price action has been really, really very, very strong, and as a result, dragging our market risk indicator well up now into moderate risk territory, and not that far from sort of low risk. And so it really just goes to show you that when you get really strong price action, that it can certainly drag that market risk indicator up. Keeping in mind it does lag, as all price action does, other than the candles themselves. So certainly looking at a lot better than what the market did a little while ago. There's still a fair degree of volatility in the market with a lot of earnings in the US as well. And if you're not hitting your targets there, then certainly you can see big drops in prices, and probably that's where the US, whilst recently it's actually been a little bit less volatile than what the Australian market has, but individual stock volatility can be quite severe during earnings seasons. Even Australian stocks, if they don't happen to reach targets and things, might drop 10%, like we saw Woolies, I think it was, or an announcement yesterday. Jeff, you probably know a little bit more about that. Guidance, I think it might have been, or something, and the stock dropped 10%. Well, sometimes in the US, stocks can drop 15, 20, 25% just through a simple announcement or some earnings.
Yeah, I mean, in the US, they've got 4 earnings seasons. They announce results every quarter. Here, I think we actually do it better in Australia. It's every 6 months, so the companies don't have such short-term focus. So the earnings season you talk about, obviously we get in Australia in Feb and August. What we're going through right now, and Woolies as an example, is it's basically AGM season, annual general meetings. The companies are holding their an opportunity to have a face-to-face with shareholders, and they say, generally, here's how we've done in the last few months, and this is what we're looking forward to for, say, FY16. So it's not results exactly, but it's certainly an opportunity for companies to get things off their chest in a good and bad way, to say, we've had a ripper start to the year, or sales have been sluggish and we're really worried about this year ahead. So again, you might see the market flat, but during that time you've got many more stocks that are up or down 3, 5, 10% compared to a typical day in the market.
And that's really interesting, particularly seeing this strength, of really strong price action there, where the collapse was quite horrific, and once the volatility started to reduce and the market started to move back up, it's moved back up very, very quickly in a short space of time. And those stocks in the US watch list that weren't stopped out during this particular period have actually held up really, really well, and really started to move up very, very nicely, and starting to get back to higher highs, and as a result dragging their trailing stops upwards, which is a really positive sign. But on the back of that, as we just talked about earnings season, some of those now with earnings coming up have either benefited from that, or in actual fact gone the other way as a result of announcements, etc. And again, the volatility stock-specific volatility is quite significant. Let's go and have a look at what we've got coming up on the market next week. Jeff, what are the market shaping events you see there on the calendar?
Yeah, look, in Australia, obviously, the big one is the RBA, and I spoke about that. I think rates will be on hold, but November is a month that the RBA likes to act, so certainly a chance we can see a rate cut there. And also with the banks having put up mortgage rates by around about 20 basis points, the RBA can then say, look, we can cut rates, and it's just back to where it was. So that's another sort of case for rate cut. Over in China, actually, this is really interesting. So I talk about PMI data in China, and I've said that this is the most important piece of data for me coming out of China.
Yep.
And there's a few PMI numbers, but I'll just recap it quickly again. There tends to be, it's like a survey of businesses, of factories, and an early survey comes out about 3 weeks into the month, and then the final survey comes out at the end of the month. They've just scrapped the preliminary, the flash number. So instead of getting a flash reading, in the 22nd, 23rd of the month, and then another one at the beginning of the next month, it's just that final one. And it's a bit interesting because HSBC was responsible for doing there's official Chinese figures, which always come in pretty predictable and steady. And then there was the HSBC numbers. Obviously, they were doing their own survey. HSBC had been doing it for years, and then about 6 months ago said, we've had enough. Another mob, Caixin, which is a Chinese business journalist media company, business media company, took over, and now they're suddenly dropping one of their surveys. So maybe there's a little bit of influence from certain people, from certain institutions in China to maybe bring the PMI data so it might maybe a bit closer to the official figures. So there is a chance that maybe this data might not be at the holy grail of economic indicators moving forward. So just something to keep an eye out. Certainly something I'm watching, but every couple of changes happening in that space.
So the fact that we're not having as much data, PMI-based data coming out of China as regularly, is that likely to reduce volatility or increase it when it comes out?
It's a good question. Look, probably reduce. I think. I mean, we tended to get the big reaction would be at the flash numbers, and then a week later, a little bit of a secondary reaction, and then the official numbers are actually, I wouldn't say useless, but were very much just sort of secondary. We got the big story a week ago. Now it's a little bit different. We've already had our reaction, so I think you'll probably now get that big reaction to the one-off numbers. So from that perspective, the one-off numbers give rise for maybe a bigger surprise. But I think you don't have the two releases, and and maybe you'll find that the numbers will be a little bit closer to the official numbers moving forward. If maybe I'm reading too much into it, I don't know. But when I see quite a bit of tinkering in economic data, particularly in a country like China, which admittedly has there's question marks over the reliability of data. A little bit of a warning sign for me. Over in the US, look, without going through all the bits and pieces, they've got their own PMI data and then jobs data. Really, everything in the US from now on takes on the significance of how does this influence the Fed. And they've said, look, if we see signs of economic improvement and strength in the US, then we're going to raise rates. So these numbers will all be very, very closely watched next week, and have a big say. And so we didn't mention earlier, but the US also brought out GDP numbers recently that were weak. I think unless the numbers are particularly strong, I think you'll probably end up seeing rates on hold until next year.
Very good. All right, that concludes this week's macroeconomics analysis session. Thank you for watching. Have a good weekend, and if you're betting on the Melbourne Cup next week, Maybe the best bet would be to have a bet on interest rates staying on hold, Jeff.
I think so. I think that's a good value bet.
A safe one, anyway. We'll have to wait and see. Have a good weekend, and those of you on the Elite Traders Club, I will catch up with you at 9 a.m. on Monday morning. Bye for now.
Bye for now.